capital asset uh, can be transferred or it is taken to be a transfer. What are the difference between short-term and long-term capital gains? And what can be the tax saving opportunity in case of long-term capital gains? And what are the tax compliances that needs to be adhered to, kept in mind during ITR filing and during the year. And finally, we are going to take a look if at all tax liability is coming up, how we can mitigate it. Now, firstly, we are going to take a look at since the year is actually ending and from 1st of April the new year will be starting, and in the month of June and July, whenever you receive your form 16, there are certain documents that you need to be kept in hand, right? So we are going to take a look at all the documents that you should be keeping in hand before filing of income tax return, right? uh, so that you can have a full understanding and ready-made document folder with you. Firstly, most importantly, form 16, 26 as and annual information statement. Now these three are the basic documents for you to file your income tax return. Form 16, it is issued by your company, which actually captures all the basic details of salary. It captures if you are getting any HRA, if you are getting any ATC deductions, professional taxes, standard deduction, etc. etc. 26 says it actually captures all the income against which tax has been deducted. Now, there are certain items which are not reflected in Form 16, but those details are available in 26As. For example, FD interest, right? So if you are making an investment in FDs, fixed deposit, and against which tax has been deducted, they will appear in 26As. If you are getting any dividend from Indian companies and against which tax has been deducted, they will be appearing in 26As. So 26As is another most important document for you to file your income tax return. And thirdly, AIS, Annual Information Statement. Now, Annual Information Statement is a document which actually includes all of your income, and regardless of tax has been deducted on that income or not. For example, savings bank account interest. If you are keeping money in savings bank account, then there is a very good chance you will be getting some amount of interest from that savings bank account. Now, those details are not available in 26As. However, those details are available in AIS because banks are required to submit this kind of information to income tax department. How much savings bank account interest you are getting, how in case you are selling shares or selling any property, those details will be coming to income tax department through other third parties. For example, if you are selling shares, in that case the depository, right, like NSDL or CDSL, they will be submitting this information to the income tax department. In case you are selling off property or purchasing any property, that detail will also come from registrar's office. So before filing in your income tax return, these are the documents you should be keeping in handy, and you need to refer to them so that you can fully disclose your incomes. Form 16, 26As, and AIS. Secondly, last year's income tax return copies. Now, last year's income tax return copies are primarily important if in last couple of years you have carried forward any losses. Now, losses can be carried forward up till 8 years if you are filing the income tax return within the due date. And if you are compliant enough, then you must have filed the income tax return within the due date, right? So, in any of those years, if you have incurred any capital losses, in that case, those losses can be carried forward if you have reported those losses by filing the income tax return within the due date. Now, when I say due date, I do not mean the extend. I do not mean the belated returns due date. I mean the original returns due date that actually happened on 31st July 2022. Similarly, for 21, the due date was 31st of December, and for 20, it was 10th of January 2021. Now, if you have filed the income tax return within those dates in last 3 4 years, then most definitely you will be allowed to carry forward the losses. And in this year, in this financial year, if you have earned some capital gains, then those carry forward losses can be used to set off the carry for the current year gains. Therefore, this document is absolutely necessary, last year's income tax return copy. In the income tax return, you need to mention what kind of loss you are carrying forward, and when did you file the income tax return. Furthermore, there are certain other documents that are also needed in case if you have missed the proof submission deadline, right? So at the beginning of the year, we are supposed to select the tax regime, the new regime or the old tax regime, right? And along with that, we are supposed to declare all the investments that we have or we are going to make during the year. If we are staying in a rented premises, we are required to submit the rent amount, right? We are required to declare the rent amount. If we are making any investment in any life insurance or medical insurance, those sort of information we are required to submit. Now, if you miss the window to submit the proof, you have declared them, but you have missed the opportunity to submit the proof. In that case, those claims were denied at the time of preparing the Form 16, and you will see a higher amount of tax outflow. But these deductions can be claimed at the time of filing your income tax return. Therefore, if you had missed the opportunity to submit the proofs, uh, you can claim them at the time of filing your income tax return. So these document you should be keeping in hand. Now, the documentary list of document list of what are the things that we need to keep in hand at the time of filing income tax return. I hope that is very much clear to you. Now I would like to move on to the main topic of today's webinar, that is capital gains and its tax implication. Before going in depth into capital gains, let's try to understand what constitutes a capital asset. Now, capital asset is any kind of property held by any person. Now, this is a common parlance. However, in income tax, in the eyes of income tax, to be called a capital asset, it has to be of certain characteristics. Firstly, it does not include any items that are held for personal usage. For example, a car, a motorcycle, a motorbike, clothing, laptop, mobile, etc. etc. These are items which are held for personal usage. Now, if you are selling them even at a profit, no capital gains implication will be coming to you. However, jewelry, work of art, shares, and securities, those actually fall within the bracket of capital asset. Now, we may say that jewelry is used for personal purposes, right? If we are attending any marriage ceremony or going to a function or something like that, we take out our jewelry and we wear them. So they should be considered as item for personal usage. However, in the eyes of income tax act, it does not really happen. They have specifically included jewelry, bullion, etc., etc., as part of capital asset. Furthermore, any paintings or sculptures of any of that kind, that also are treated as capital asset. And if you are selling them off, then in case you are getting any gains, it needs to be shown as capital gains in your income tax return. Now, hopefully, what is capital asset is clear to you. Now, let's try to understand what actually constitutes a transfer. Now, transfer actually means sell, exchange, or relinquishment of right upon an asset from an asset, right? Uh, so, sell, it is pretty much clear that I have an asset. Say, for example, I have shares of A company. I am selling that off and getting some money against it. That is actually sell, and it constitutes transfer of asset. However, exchange can also be treated as transfer of an asset. Now, for example, I have shares of A company, right? I'm going to my friend and telling me, give me your shares of B company in exchange of shares of my A company. In that case, exchange will happen and transfer will take place as well. And if you are making any gains from it, in that case, you will be charged for capital gains. Thirdly, there are certain conditions wherein you do not receive any kind of consideration as such, but your right from an asset gets extinguished or removed. In that case, also transfer of capital asset happens, right? For example, there is a company, right? There is a company whose shares you are currently holding. Couple of years down the line, that company goes into liquidation, right? Now, if the company goes into liquidation, rights of those shares, your right of those shares, they are extinguished. Those shares are expunged. They cease to exist. In that case, also transfer of capital asset happens. However, in this situation, if the shares of the company are liquidated, right? The company has gone into liquidation. In that case, you can suffer a loss, and that loss needs to be reported in the income tax return as well. Finally, redemption of bonds or maturity of bonds. Now, if you are purchasing bonds of a company, then those bonds come with maturity date, right? Upon its maturity, you are supposed to get the principal amount along with some interest component as well. Now, on its maturity, it can actually give you capital gains, and transfer of capital asset actually takes place. Now, transfer and capital asset, what is capital asset? That is absolutely fine. However, determination of capital asset or determination of capital gains actually depends upon a couple of other things. Number one, the holding period of an asset, right? Now, holding period of an asset plays a very, very, very important role in determining the taxability of an asset. Usually, the long term, if the assets are held for a long term basis, and any gains that is arising from that long term assets, they have a little preferential treatment in the eyes of Income Tax Act. For short term asset, there is no such preferential treatment. Now, preferential treatment comes in by extending tax saving opportunities, by giving lesser tax rate. Therefore, if you have an asset, try to hold them for a long term period, then sell it off, which can give you a little bit better position in terms of taxation. Now, normally, uh, if any asset is held for a period uh, more than 36 months, in that case it is treated as long term capital asset. If any asset is held for a period not exceeding 36 months, it is treated as short term asset. However, there are certain cases for which this duration of 36 months has been cut short. One of the example is listed equity shares and listed equity mutual funds. Now, when I say listed equity or listed mutual funds, I mean to say those shares should be listed in recognized Indian stock exchanges. Many of Indians, upon opening up the entire global financial situation, they are looking to invest in foreign countries, right? People are increasingly more investing into US stock exchanges. Now, those shares, since are not listed in any recognized stock exchange in India, they do not have the equal footing of listed shares in India, even though those shares are listed outside India. Now, unlisted equity shares only or removable property, for them also the holding period has been cut short. Now, they are not cut short by 12 months, no, but the period of holding for them are 24 months. Now, if any unlisted equity shares or immovable property are held for a period in excess of 24 months, they are treated as long term capital asset, and any gains arising from transfer of such asset are treated as long term capital gains. Any of those assets, unlisted equity or movable property, if they are held for a period up to 24 months, then they are considered as short term asset, and any gains arising from it are treated as short term capital gains. Normally, short term capital gains are taxed at marginal slab rate. For example, if a person's marginal slab rate is 30%, then the short term capital gains will be taxed at 30%. However, there is an exception to it. That is, if listed equity shares, Indian listed equity shares, and Indian listed equity mutual funds are sold, in that case, special rate of tax of 15% is applicable. Now, let's understand the holding period for long term asset. Now, as we have mentioned, listed equity shares, uh, in case they are held for a period which exceeds 12 months, they are treated as long term capital asset. Now, since they are listed equity and equity mutual fund, the rate of tax for them is 10%. Now, we have mentioned that long-term capital asset enjoy special benefit in terms of rate of taxation and tax saving opportunity. This is one benefit which is assigned specifically for listed equity and equity mutual fund. Furthermore, in case you have a gain from selling of equity mutual funds or equity shares, you are not supposed to pay taxes if the gain amount is more than less than 1 lakh rupees or up to 1 lakh rupees. Now, this benefit is given to you by way of giving you a deduction. How this actually happen is, firstly, in your total income, the gain amount will be added, and later on, at the time of computing the taxes, 1 lakh rupees of deduction will be provided. Up to 1 lakh rupees of deduction will be provided. If the gain amount is lesser than 1 lakh rupees, then the entire gain amount will be given as deduction. If the gain amount is more than 1 lakh rupees, say for example 1 lakh 20,000 rupees, then a deduction of 1 lakh rupees will be given to you, and on remaining 20,000 rupees, 10% rate of tax will be applicable, thereby given to you a tax of long term capital gains tax of 2,000 rupees. There again, there is a special case in case of listed equity, which are not equity or equity mutual fund. Usually, they are bonds of a company. Now, bonds of a company has a special tax rate of 20% with indexation benefit and 10% without indexation benefit. Now, before we get into the tax rates and everything, let's try to understand what is indexation. Now, indexation in simple terms is upliftment of cost, right? So, if any asset has been acquired 10 years ago, most definitely you would have paid a lesser amount of money as compared to today's standard to acquire that asset, right? Therefore, if we at the time of computing the capital gains use the actual amount spent to compute the capital gains, it will be an unfair proposition, right? Because capital gains is computed by reducing purchase price from selling price. Therefore, since there is a disparity of uh, pricing, right, because of inflation and everything, it becomes unjustified. It becomes unjustified if you take the actual selling price, actual purchase price, sorry, which happened 10 years back, and use that purchase amount to determine capital gains. Therefore, every year income tax department issues a indexation point. Now, using that indexation point, you are supposed to get a indexed cost of acquisition, which actually means if you would have uh, if you would have purchased that asset in today's standard, how much money you would have spent, right? So presently the indexation point, the indexation year starts from 1/4/2001. From that year onwards, the income tax department issues indexation points. The indexation point for 2001 to financial year is 100, and for this year, financial year 22-23, the indexation point is 331. So, if you have purchased an asset in 2001 to financial year by spending 1 lakh rupees, after indexation, the price will be coming to 3,31,000 rupees, right? Now, assume that asset is being sold at 5 lakh rupees, right? So if we do not do the indexation, I will be getting a capital gains of 4 lakh rupees. However, if we utilize the indexation, I will come to know that actual purchase price of that asset in today's standard would have been 3,31,000 rupees, and I will get a capital gains of 1,69,000 rupees, assuming the selling price is still 5 lakh rupees. Therefore, indexation plays a very important role in determining cost of purchase. Now, one thing we have to remember that for computing the gains of listed equity or equity mutual funds, we do not do indexation as it is prohibited by the Income Tax Act. For computing the gains of any other asset, for example, unlisted equities or land, building, etc., we can use the indexation. Now, uh, now we are going to take a look at the tax saving opportunities on capital gains. Now, tax saving opportunity are present only in long term capital gains. If you have short term capital gains, then there is zero chance of you saving the income tax on those gains until and unless you have some unexhausted basic exemption limit. Excuse me. Now, the ways you can save the taxes is utilizing section 5454F or 54EC. Now, under section 54, it is applicable if you are selling of a house property and investing the gain amount in purchase or construction of another house property. Now, there are certain conditions embedded in section 54. For example, uh, in case you are selling of the house and then purchasing or constructing another house, in that case, if you are purchasing, then the purchase needs to be completed within a period of 2 years. If you are constructing, then it should be done before expiry of 3 years. If, however, you are first purchasing the house and then selling off another house, in that case, maximum time period you can go back is 1 year, right? So, if you are starting to construct a house property and then you are planning to sell off another house property or flat, maybe, in that case, the gap between these two events should not be more than 1 year. Secondly, if you are selling any long term asset and if you are investing the entire sum of money into a purchase of house property, in that case you can get the exemption on the entire capital gains. Now this section 54 deduction works a little bit differently than section 54. In section 54 you are supposed to invest the gain amount so that you can save the capital gains taxes. However, in section 54F, you are supposed to invest the entire sale proceeds. Then you will get the entire capital gains as exemption. For example, uh, let's assume you are selling off shares of company A, right? You are selling them off for 10 lakh rupees, right? And the gain that you have is coming to 5 lakh rupees, right? Now, if you are investing the entire sum of 10 lakh rupees in purchase of a house property or purchase of a flat, in that case, the entire 5 lakh rupees will be given to you as deduction, an exemption. However, if you are using only half of it, right? So instead of using 10 lakh rupees, you are only utilizing 5 lakh rupees. In that case, half of the capital gains, that is 2.5 lakh rupees, will be given to you as exemption. Remaining 2.5 lakh rupees will be taxed in your hand. Now, there is another section, that is section 54 EC, uh, which can come into play as well if you are not planning to purchase any house property. Now, section 54 EC primarily says if you are selling of a house property and investing the amount, right, investing the gain amount in specific bond which has a lock-in period of 5 years, you can save the taxes on it. Some of the bonds are RECL bonds or NHAI bonds, Railway Finance Corporation bonds. Now, maximum amount of deduction that you can get is 50 lakh rupees, and those bonds are to be acquired within a period of 6 months from the date of transfer. There are certain situations you cannot utilize a fund within the return filing due date. In that case, you need to invest the amount in capital gain savings scheme account, right? And later point of time, you can withdraw from that particular account and invest in a, specified asset. It can be a house, it can be any bond, etc., etc. You must note that if you capital gain savings scheme account is not an alternate is not an alternative to invest in specific asset. Capital gain savings scheme account is there so that you can park the amount in case your chosen asset is not available at that moment of time. You still have to invest in proper class of asset. CGSS is there so to give you a facility in case the asset that you are looking for is not available for purchase or invest at that point of time. Now we are going to look at the capital gains in case you are selling of a house property. Now, for a house property, It needs to be held for a period in excess of 24 months so that it is considered to be a long term asset, and any gains coming out of it is a long term capital gains. Now, since this is a long term capital gains, it can avail the indexation benefit on the purchase price of that house. So, if the house is purchased in 2001 2 financial year, the indexation point for that year is 100. And if you are selling that house property in 22-23, in that case, the indexation point is 331. So, if you have purchased that flat by paying 10 lakh rupees, uh, the indexed cost of acquisition will make the flat of 33 lakh 10,000 rupees, right? Now if you are selling that house property for 40 lakh rupees, in that case 6 lakh 90,000 rupees will be your long term capital gains. Furthermore, if you are making any improvement on that house property, that can be taken as cost of improvement, and it can add up to the cost of acquisition as well. For cost of improvement, you can also take benefit of indexation in case they are done more than 2 years back, right? Now, what actually constitutes a cost of improvement? Many of us think that small improvements, say for example, a wall has been chipped, therefore, you are making some sort of excuse me, some sort of painting to cover up that chip, or you are fixing electrical equipment, for example a fan, that will make it a cost of improvement. Frankly, those are not cost of improvement. If you are completely renovating the house, for example if you are completely redoing the flooring, if you are completely redoing the roofing, you are tearing down a wall, completely restructuring the house, in those cases, cost of improvement can be considered. Just because you are replacing a light bulb or you are fixing a fan, those are not cost of improvement. In simple terms, cost of improvement is those costs which are carried out so that the life of the property is increased, or the value of the property is substantially increased, right? So substantially increased, for example, uh, you had a cement flooring, right? But you are removing that cement flooring and carrying out a marble flooring. In those cases, the value of the property is substantially increased and cost of improvement can be considered. Now, at the time of selling the property, sometimes we appoint a broker who actually facilitates the sale. And if we are appointing a broker, he is taking a brokerage amount. Now those amount which are done exclusively for the sale can be taken as selling expenses, right? So, though the brokerage, any advertisement, maybe you have to travel to some place to carry out the selling, those expenses can be deducted while computing the capital gains. And once you arrive at the capital gains, you can take benefit under section 54 or 54 EC to save the capital gains. Now, let's talk about advanced tax implication. Now, advanced tax implication comes if your tax liability is more than 10,000 rupees. Now, advanced tax, your tax liability or is more than 10,000 rupees. This is computed after all the TDS claim is taken care of, right? For example, you have only salary income, right? And you have capital gains. Now, on salary, your employer is deducting XYZ amount of taxes. However, the capital gains will give you an additional tax liability of 1 lakh rupees. In this case, advanced tax implication lies upon you, falls upon you, Therefore, you need to be paying the advance taxes. In case you are not paying advance taxes, there is a interest chargeable upon you at the rate of 1% per month. Now, advance tax, the good thing about advance tax is it need to be paid at one go. You can pay the advance tax in a quarterly fashion. The dates on which the advance tax need to be paid are 15th of June, September, December, and March during the entire financial year. You can pay a bit earlier than that, but these are the last date of every quarter: 15th of June, 15th of September, 15th of December, and 15th of March. Consequently, the advance tax percentage is also determined 15%, 45%, 75%, and 100% on those 4 quarters. Now, if you are not paying the advance taxes, uh, interest under Section 234B and 234C is applicable upon you. If you are not paying the 90% or more taxes by 31st of March, then interest under Section 234B is charged. And if you are failing to pay the advance tax in installments, 15, 45, 75, or 100%, in that case, 1% interest per month is applicable upon you. Now, these are the detailed discussion analysis of capital gains and advance taxes, and we are going to address the questions right now. If you have any questions, please drop them on the chat box. Right. We are going to wait for another couple of minutes. If no questions comes up, we are going to conclude this session. Right. So thanks for joining with us. It's been great. I hope you had some takeaways from this session. Have a great day.